Good morning, everyone. I want you to imagine a world where the rules of money and value are being rewritten right in front of us. Not gradually, but decisively. A world where we're witnessing the birth of a true global monetary system built on digital rails, unrestricted by borders, unchained from old paradigms. That system is embodied in Bitcoin. Today, I want to make a bold but entirely research-driven case that Bitcoin could hit $1,000,000. Yes, you heard that right. And what I'll walk you through is how and why. When we think about the future of wealth and innovation, one lesson is crystal clear: relying on a single currency or a single form of money is risky. The world is changing faster than ever before. Technology is evolving, markets are becoming more interconnected, and the nature of value itself is being redefined. The concept of holding everything in one traditional currency simply does not match the reality of a global, dynamic economy. Historically, we've seen the consequences of putting all faith into a single monetary system. Inflation, monetary policy shifts, and geopolitical events can erode purchasing power almost overnight. The challenge is not only preserving wealth, but ensuring that it grows in alignment with innovation and technological progress. A diversified approach to currency and value creation is no longer optional. It is essential. We are witnessing the emergence of alternative forms of money and digital assets that operate independently of traditional financial institutions. These innovations are not speculative fads, they are responses to structural inefficiencies in the financial system. They provide a way to participate in a more transparent, rules-based form of value transfer that is accessible globally. By incorporating these alternatives into a broader strategy, individuals and institutions can reduce systemic risk and benefit from the potential growth of new economic paradigms. The principle here is simple: diversification across currencies is a hedge against uncertainty. It is not about abandoning traditional forms of money, but about recognizing that no single currency, no matter how dominant today, can guarantee stability in a world defined by rapid technological and economic change. When capital flows are global, supply chains are interconnected, and innovation cycles are compressing, having multiple avenues for storing and transferring value becomes a strategic necessity. Moreover, diversification aligns with the long-term philosophy of investing in innovation itself. Assets that are part of evolving ecosystems tend to benefit from network effects and adoption curves, which a single currency alone cannot provide. By being open to multiple forms of money and value, one participates in the broader narrative of economic transformation rather than being constrained by traditional, static models. It is also important to emphasize conviction. Diversification is not merely about spreading risk, it is about positioning to capture the upside of the next wave of economic change. While volatility is inevitable in emerging currencies and digital assets, disciplined participation and strategic allocation provide the ability to harness long-term growth. Patience, research, and an understanding of the underlying technology and principles are crucial. In conclusion, placing all trust in one currency limits opportunity and exposes you to unnecessary risk. The world is moving toward a more complex, interconnected, and innovative financial landscape. Those who embrace multiple forms of value, who recognize the structural shifts underway, and who commit to long-term thinking, will be the ones best positioned to protect and grow wealth. In a rapidly changing economy, diversification is not just protection. It is empowerment. In an age defined by rapid technological change and financial innovation, one principle remains timeless: owning real, tangible things matters. When we talk about real assets, we are talking about things that have intrinsic value, assets that are not merely entries on a balance sheet or digital abstractions, but things that the world needs, uses, and cannot simply create out of thin air. Land, energy, essential commodities, infrastructure, and productive technologies form the backbone of long-term wealth creation. The lesson is clear: financial markets are full of noise, short-term speculation, and fleeting trends. While paper wealth can fluctuate wildly, real assets provide a foundation that grows in value as the world grows. They are linked to human productivity, innovation, and the global economy. As populations expand and technology evolves, demand for real assets increases. By owning them, One captures the tangible outcomes of progress rather than relying solely on abstract valuations or temporary market sentiment. Consider technology and innovation as real things in a broader sense. Companies building critical infrastructure, creating transformative tools, or enabling new industries are producing something that has lasting impact. Investing in these real things is a way to participate directly in progress. It is not about chasing the latest fad, it is about identifying where value is being created in the world, understanding the forces behind it, and positioning to benefit from the adoption of these essential technologies. Real things also serve as a hedge against uncertainty. When markets are volatile, currencies fluctuate, and economies face disruptions, tangible assets maintain value because they are rooted in fundamental utility. A factory that produces energy, a network that facilitates global commerce, or a resource that underpins essential industries cannot disappear overnight. By owning real things, investors are better prepared to navigate periods of uncertainty while participating in the upside of global growth. The mindset required to own real things is long-term, research-driven, and disciplined. It demands a focus on underlying trends rather than short-term fluctuations, on the practical utility of the asset rather than its headline value, and on the broader forces shaping the economy. It requires patience, conviction, and the willingness to hold through volatility, because the rewards of real ownership are realized over years, not days. Ultimately, owning real things is about aligning capital with progress. It is about ensuring that wealth is connected to productive outcomes, to innovation, and to the forces shaping the future. As the world becomes more complex, more interconnected, and more technologically advanced, the assets that underpin tangible growth will become increasingly valuable. For those who recognize this, ownership is not just a strategy, it is a philosophy. It is a way to ensure that your wealth grows alongside the world, anchored in what is real, meaningful, and enduring. In the rapidly evolving landscape of technology, finance, and global markets, one principle stands out as both timeless and critical: diversification is protection. The world is moving faster than ever, and relying on a single asset, market, or strategy exposes us to risks that are increasingly difficult to predict. Diversification is not simply about spreading investments randomly, it is a disciplined approach to positioning capital across multiple, uncorrelated sources of value, reducing vulnerability while enhancing the potential for long-term growth. History teaches us that concentrated positions, no matter how attractive in the short term, can create exposure to systemic shocks. Innovation cycles are inherently unpredictable. Markets can swing violently, and unforeseen events can erase value in ways that traditional metrics rarely capture. By allocating resources across multiple avenues, different asset classes, regions, and technologies, we are not diluting opportunity, we are safeguarding it. Diversification allows us to participate in the upside of multiple trends while minimizing the impact of any single adverse event. Think of it in terms of the broader innovation ecosystem. Emerging technologies, groundbreaking infrastructure, and evolving digital assets each move along their own trajectories. Some may experience explosive growth while others may face temporary setbacks. By engaging across multiple areas, we create a portfolio that captures the long-term rewards of technological progress without being derailed by short-term volatility. The goal is not to avoid risk entirely, which is impossible, but to manage it intelligently so that opportunities are maximized while losses are contained. Diversification is also about perspective. In a world of rapid change, focusing too narrowly on one asset, one currency, or one sector can blind us to other avenues of value creation. Broader exposure enables us to understand trends, recognize correlations and divergences, and respond with flexibility rather than rigidity. It allows us to maintain conviction in long-term ideas while acknowledging that no single path to growth is guaranteed. Ultimately, diversification is protection because it aligns with the natural uncertainties of innovation and progress. Markets fluctuate, technologies evolve, and global economies shift, often in ways that are unpredictable. A well-diversified approach provides resilience, allowing investors to stay the course through volatility, remain engaged with transformative trends, and capitalize on opportunities as they emerge. In essence, Protecting wealth is not about avoiding change, it is about positioning to thrive within it. Diversification is a strategic framework that ensures participation in the growth of multiple areas of innovation while mitigating the risks that accompany uncertainty. It is a proactive approach to managing capital in a world defined by speed, complexity, and constant evolution. Those who embrace diversification are not merely hedging, they are building a foundation that allows them to navigate disruption, capture the rewards of innovation, and secure long-term success in a world that waits for no one.